Hey TMFG community, Carlo Cansino here with John Iaconetti, and in today's Ask TMFG episode, John will be discussing the current market volatility and why it may not make the most sense to rush into GICs. If you do like our content, please do subscribe to our YouTube channel, give us a comment if you like what you're hearing, or give us a like. In today's episode, John will be discussing the market volatility and why we shouldn't be rushing into GICs. I know with rates climbing, they look more and more attractive from where they previously were, but now may not be the time to forget about long-term investing and look for short-term returns. John?
Perfect. Thank you, Carlo. So just like you mentioned, today's focus is going to be about those types of investors that are looking to get into GICs, especially during market volatility. And they tend to have similar type of profile, right? You're naturally probably not a big risk taker or maybe a bit more on the conservative side when it comes to investing when you're already starting to think about GICs. And especially during a time like this in the market, when the volatility is making you a bit uneasy, you see that GIC there, rates are higher now than they have been in the past, call it 5-10 years, what have you. So naturally you feel that inclination to go towards a GIC. It may be providing higher returns than it have in the past, but what we focus on when we invest is not only trying to make as much money as possible, but we're also focusing on exceeding that inflation rate. So think about this. If you just had $1 million and you kept it at $1 million between now and 20 years from now, you probably feel like you did pretty well. But what's going to happen over that period of time is cost of living is going to continue to go up and up. So suddenly that $1 million that you have in the future isn't worth nearly what it should be or as valuable as it once was. So that is the whole purpose of investing. Our goal here isn't just to grow the principal or the amount that you have invested. It's to grow that amount above the rate of inflation. Now, as many of you may know, inflation's been relatively high in the past, call it even 12 to 18 months. And a lot of that has to do with the pandemic. But when you're getting a GIC rate, at 3-4%, but inflation's at 7%, you're still losing 3% of your purchasing power every single year. Now, what we do know about the markets is one way you always exceed inflation, or you can exceed inflation, is by doing it through a globally diversified portfolio. It's responsible in the fact that you're still investing in stock, so you have the opportunity to exceed inflation, but you also don't run the risk of really losing your principal value. You don't have the risk of going bankrupt on one of those holdings. So pump the brakes when you see those GIC rates. They look attractive, but at the same time, think about that. Think about, are we going to be able to exceed inflation with this rate going forward? And really, in the grand scheme of things, it is done through investing in stocks historically. And one interesting point to that note, we were listening to a Nick Murray webinar, and some of you may be familiar with Nick Murray. He provided an excellent example, and this is from Apple. So what Apple had done is they had provided bonds or debt instruments to its investors, and were paying a certain interest rate on that debt. But their focus was to raise that capital through debt to buy back their own shares. So if you see a big institutional company handing out debt and gladly paying the interest rate on that debt just to use that money to invest in themselves, that's a pretty telling sign that stock prices or shares is going to exceed that fixed income would have. Fixed income is a bit more of the secure portion. What we know is going to outperform in the long run is individual stocks. So I just thought that was a pretty interesting real world example that they made it very clear that they're going to issue these just so they can buy back their own shares. People still did it. At the end of the day, what you should be doing is thinking, well, if they're going to buy their own shares, we should probably invest in shares as well. So just a little something to think about, but going forward, our main focus here is exceeding inflation. Globally diversified portfolios is what's going to do that.
Thanks, John. You're right. In today's market volatility, the guarantee of an interest rate and not losing your capital is pretty compelling. But for those that have long-term time horizons or want growth in their portfolio that will have at least the opportunity to outpace inflation, you need exposure in the stock market. As far as the markets come down, that means the expected rate of return is going to be much higher, far higher than what can be expected in GICs right now, even though the GIC rates are higher than they were a couple months ago. Again, that's our episode for today. If you do like our content, again, please do subscribe to our YouTube channel. We're always looking for feedback, so provide a comment if you like, or just give us a thumbs up. Until next time, I'm Carlo Cansino.
I'm John Iaconetti.
And this has been Ask TMFG.